They did not hike rates. They kept interest rate at 0.5%. The vote, though, as expected, was 7-2, so you had two dissenters there. The BOE, though, does see inflation cooling faster to reach the 2% goal in 2 years. Part of the rhetoric of why they were going to be hiking was because inflation was was jumping further because of sterling weakening, and now they see it actually cooling faster than before. You have sterling actually pairing some gains after that BOE decision, David.
Yeah, you'd be a little disappointed if weather didn't figure in, though. The first quarter GDP weakness is temporary. They had some bad weather over there, as I recall, in the first quarter.
And the market reaction: gilts rise, yields drop, cable pairing some of those gains. Now we're joined by Guy Johnson, Bloomberg News over in the UK. What are your takeaways here, Guy?
Basically, the Bank of England seems to be backing off a little bit. It's talking about the fact that while the GDP weakness that we've seen recently is only temporary and does expect that to be revised higher, it's talking about the fact that it's only limited tightening will be needed in the coming years. This explains why what we're seeing in sterling. In some ways, the 7-2 was the kind of the hawkish hold that people were talking about, but it's the kind of the secondary lines relating to kind of how quickly inflation is coming back down to target. And the story about kind of what's going on more broadly in the economy. They're talking about the fact that ongoing rate hikes needed to control inflation, but its forecasts are based on about 3 rate hikes over the next 3 years. So that kind of leaves us one more this year, maybe kind of August or maybe December, one the year after that, one the year after that, i.e. the rate path is not as steep as maybe the market was looking for, and this is what is dragging the story down when it comes to sterling. But 7-2 is still the vote, so it's kind of the bank, I think, is basically buying a little bit of time here. It's going to wait and see whether or not the data does turn out to be temporary. It's kind of downgrading its expectations a little bit on kind of what the path of inflation is going to look like, and it's coming down a little faster than anticipated, as a result of which it's probably not going to need as many rate hikes going forward from here. My sense kind of is that maybe the bank just waits and sees what the data looks like going forward from here. Carney maybe made the error of kind of pre-committing a little bit too much and then had to walk it back when the data softened up. Maybe they'll become even more data dependent going forward from here. But the sense certainly seems to be that this is an economy that won't need the kind of rate hikes that originally or kind of were priced in only a few weeks ago.
Guy, you said maybe there's a little bit of overreaction. I must say the Bank of England seems to be the most exciting central bank, at least among the developed economies right now, because they got our hopes all up. I mean, there wasn't that long ago, we were 90% likelihood of a hike about now. So what is going on? Are they overreacting to the data, as you suggest, or are the data really more erratic in terms of the British economy right now than for other developed economies?
I think the bank has been surprised by what has happened in terms of the way that the data have come through, and the data are weaker than the bank was anticipating. I think there is a desire, and this is a little bit similar to the Fed. I think there is a desire at the bank to normalize rates. So maybe the Mark Carney kind of school has been, we'll do what the Fed is doing, and we're going to look to normalize rates. Whereas with the ECB, it's kind of, let's hold off as long as we possibly can. And maybe actually the bank needs to be more in the ECB kind of school of thought rather than the Fed kind of school of thought. And maybe we're starting to see that coming into force here.